Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 265th VideoCast podcast for the week ending November 14th, 2024. We have got so much to cover this week. It's incredible. We're going to have a great podcast, VideoCast. But as always, family first. Here we go. This is Mimi in Chicago. Let's talk about their weekends. Annabelle and Mimi both had their first respective solo travel. Mimi went with her coach and team to Chicago for the Champions Cup in water polo, and Annabelle flew with her coach and team to San Jose. Mimi had some killer goals and has grown so much since her time at 6'8 Academy. She loves seeing Chicago for the first time and got some cool photos we're going to go through. Annabelle had a demanding meet whereby in 36 hours, she took 2 flights, swam 13 events, came home with 10 gold medals and 3 silver, set a new Southern Cal swimming record in the medley relay, broke a minute in her 100 free, and went 30 seconds in 50 back and 26 seconds as the anchor in the freestyle relay. So exciting week for the girls. That's Mimi in Chicago. That's actually a Trump building in the background, which is kind of funny for that week. So there's a mini bull in Chicago because why? Because the real bull is in New York. We do it bigger, better than those commodities folks out there. That's Mimi in front of the bean, in front of the river there, at some park thing. Okay. There's Annabelle and her teammates. Congratulations to Annabelle Hayes, Hayden Yuen, Grace Wang, and Hope Newman for setting a new Southern California swimming record in the 9 to 10 girls 200-yard medley. Congratulations to them. And then that's the Team 908 team. That's Mimi in Chicago with her teammates. And this was the most exciting trip I had to Dallas this weekend. Played Fields Ranch up in Frisco. It's the new PGA course. They're doing some majors there in the next year. There's going to be a major event in more than next year, but we can't talk about that. I took this picture here because this practice putting green is like 100 yards. It's the biggest practice putting green in the country. And then while you're putting, they have this giant screen TV with sports games, all these cool restaurants and bars around the putting green. The day before, we went to the Dallas Cowboys game, and their box was incredible. This was George and Laura Bush, former presidents, doing the coin toss in Dallas. There's that TV again. Here's the grass driving range. Hit some balls on Sunday when I landed. There's one of the holes on the West course, which we played, which as tough as it was, from what I hear, the East course is twice as hard. So next time we'll hit the East course. That's the Frisco Water Tower, which is pretty cool. And look at the size of this flag and the patriotism happening in Dallas. That's our view here as they sang and we sang the national anthem. And by the way, it looked close there for like a half a minute in the second quarter. I think it was 6-7 Dallas. And I'm sorry, Philly was winning 7-6. And then it just completely unraveled. As soon as I texted my friends, turn on the TV, this is a close one. It just absolutely blew out. So there's some more photos there. And that was just an incredible time. Thanks to my gracious host, Chris, and also Brian. Really appreciate it. That's the PGA headquarters is now at the Fields Ranch. We got this incredible bag from our generous host. Look at this incredible Titleist hat with the Fields Ranch logo. And we got Fields Ranch towels, which is just incredible. And you're going to be hearing a lot about this course in the coming years with majors coming to a TV screen near you. Couple quick highlights from Mimi's thing. Here was one of my favorite assists from watching her remotely. There she is there with the ball.
With number 13, Chloe Mulvey, wide open up.
That's that. And then one of my favorite goals right here. Look at this one-timer. This is Mimi down here.
Audrey Roberts. They'll set up their counterattack.
Boom! One-timer.
And 908 scores once again by number 14, Madeline Hayes.
All right. Yeah, that's her full name, Madeline. And that was exciting. I love that one-timer. And then I had the pleasure to join Stu Varney, literally off the red eye. Well, it wasn't really red eye. I landed at like 2 in the morning and then did the 9 a.m. hit and jet lag when you fly west to east. Anyway, it was great and got to talk about Outlook and the implications of the sweep, which was not appropriate to talk about last week, but this week it's exceptionally appropriate because if you have a reduction in the corporate tax rate from 21% to 15%, tax expense declines by 29%, which could have serious implications. Now, that probably takes earnings from 275 over 300. But if you add in the multiplier effect and the compounding effect over a couple of years, you start looking at $350 of earnings, whereas maybe without it, we would have been looking at like 310 to 320 a couple of years out, which makes us a little bit fully valued here. But when you take into effect the tax benefit and the multiplier effect and a couple of years out, makes our multiple look a lot more reasonable, which the market is sniffing out here with a full sweep of the House, and not just 1 or 2 seats, but more than that is a big deal. So let's listen in here.
Analysis of this, we've got it from Tom Hayes, who joins us here in New York this morning. Can Bitcoin just keep on running?
Well, I think, Stu, Bitcoin is the new VIX. It's a sentiment indicator. And what it's telling us right now is animal spirits are back. It has momentum. It has trading momentum. And it probably goes to 100,000. Based on what? I have no idea. But people are excited about it. The policy is pro-crypto from this new administration. And it's telling us that people believe in risk. People believe in the future. And it's also consistent with what we see since 1932. In election years, the markets, risk assets tend to rally into the inauguration. And then the first 6 months of that next year, as we absorb policy,
not so much.
Not so good. It grinds a little sideways, a little choppy before the year-end rally.
You're talking about animal spirits beginning to run riot again.
Yeah.
Okay.
Yeah.
Are the animal spirits running riot in the stock market? Are you talking about a melt up here?
It could be, and here's the white swan that very few people are talking about. Overnight, there were some news outlets kind of calling the Republican sweep. If that is confirmed, the corporate tax rate goes from 21% to 15%, which means the tax expense is reduced by 29%. Earnings power of the S&P 500 could go from 275 to 354. What does that mean in English, Stu? It means the multiple of the market comes down from 21.8 times down to 16.9 times, which would imply the market is not expensive at 21.8. It could be reasonable at 16.9 if they push that through.
But we've got to have a clean sweep. The House has to stay Republican.
That's right.
And
That's right.
that at the moment has not been confirmed.
That has not been confirmed, but you had Reuters out overnight. You had a couple other news organizations saying it's all but a foregone conclusion. So we'll know more in the next 48 hours. If that happens and the corporate tax rate drops down to 15%, we are going to see some strong economic growth over the next 4 years like we've never seen before.
Okay.
Roaring 2000s continues.
I like the sound of that. There you go. That's my mannerism, by the way. All right, Thomas, thank you very much indeed. Here's what we have.
And we're back. Thanks again to Christian Dagger and Stu Varney for having me on. That's that. A couple quotes of the week before we get down to a lot of great data this week. First and foremost, the big money is not in the buying and the selling, but in the waiting. That's from the late Charlie Munger, one of the legends. Buffett, as I always talk about, price is what you pay, value is what you get. We're going to talk about that. In an environment where things like Bitcoin are going to $100,000 and we have a little bit of crazy town happening with animal spirits, you have to keep yourself grounded, because if you don't and you get caught up in the frenzy and you buy things that don't make sense, certain companies trading at 50 times sales, etc. Sooner or later, like we saw with the SMCIs of the world that absolutely collapsed, it comes down to reality. So you just have to ground yourself when everything's moving. And we're going to show you what happened in late 2016 when Trump was first elected with a sweep, and what that meant and how there were some early fake outs. So you don't have to worry about that when you know what you own and you know why you own it. You do have to worry about it if you're trading on price and FOMO and emotion versus quality, framework, and analysis. Buffett, the most important quality for an investor is temperament, not intellect. We emphasize that each week. And then finally, Charlie Munger, all intelligent investing is value investing, acquiring more than you are paying for. You must value the business in order to value the stock. And that's why these short-term fluctuations never bother us. People are always like, you have ice in your veins. Well, no, I don't have ice in my veins. I have a consistent, repeatable framework that I apply across a basket of 10, 12 companies, and some take off immediately overnight and we reap profits faster than we expected, and some take a little bit longer, but they all work over time when the framework is correct. The only thing that can change is if the fundamentals dramatically change, then we change our mind. But more often than not, it's a time arbitrage game where we sit on our butts with low leverage, and when they reach our predetermined level of fair and fully valued, we just start to lay off as everyone else gets excited and they want the stock at the highs, and we help them out. So I put together this list of quote-unquote Trump trades because I want to show you what was the setup going into the election in November of 2016, right before Trump sweeped, and then what happened thereafter. And what you can see here, this first one is small caps, and you can see it was weakening into the election, and then as soon as he was elected, it shot straight up, a little consolidation straight up, and then it consolidated those gains for about a half a year, very similar to what we talked about with Stu, where you get a rally into the inauguration, and then you get some sideways consolidation and chop the first half, even down the first half before a year-end rally. And I just want to show you here. Yeah, this goes all the way to December. So you see this sideways chop straight up into the inauguration, chop, grind, even negative into late summer, and then a year-end rally once again off those lows. So we're going to go through asset class by asset class. Even the ARK, this is the Cathie Woods ETF that had been slaughtered in recent years, is starting to show signs of life. And as you can see, it was tech-based. So right after the election, it got a little bit of pop, and then it rolled over, and it was kind of just grinding here until the inauguration. And believe it or not, after the inauguration, when small caps slowed down, this speculative tech picked up and never looked back and was almost a double after the inauguration. So if you got most of the gains into the inauguration, this was where you picked up the mantle and got the biggest gains after the inauguration, which is going to be consistent, you'll see, with biotech and some of the other things that people think, oh, that won't work in the Trump administration. It's only industrials and energy, which is the exact wrong thing, and we're going to show you why. Let's see what's so ARK had been weak into the election. Let's see what it did this year. So it was kind of grinding sideways to weak into the election and had this huge pop. Now it probably grinds back before afterwards. It's not necessarily going to repeat exactly because there were some conditions that were different, but we want to keep an open mind here because the narratives that are circulating when you look at the empirical data are proving to be completely inaccurate. Here was BABA. BABA was weakening, had peaked in October, was weakening into the election, and weakened for another 2 months, all the way into the inauguration. After he was inaugurated, in January of 2017, BABA went from $84 to $187 in 11 months. So that's really interesting because everyone is convinced. And by the way, he ran on tariffs and protectionism in 2016 and the border, by the way. Same playbook, same hat, one extra number, and this is what happens. So on this basis, it would not be unreasonable for BABA to continue to be weak until the inauguration, although I think conditions are slightly different in that it also wouldn't be surprising for earnings to be positive. Something happened with Chinese stimulus or something or other that maybe we take off a little bit beforehand. But either way, it makes no real difference if it's a month more, 2 months more, or not. The key is that the tariff king, Chinese stocks did better than ever after his inauguration. Now, let's take a look at what happened this year. Now, you can start to see why this is going to be such a long, incredible, amazing call. I should probably be charging $50,000 for this call, and you'll see why by the end of this the podcast. But we're not going to do that. So we want to deliver value and go from there. So interestingly enough, what happened with BABA is it peaked again in October. Look what happened here. Early October in 2016, early October in 2024, week into the election, and then was weak again for the other 2 months into January 1st, was weak again into the other 2 months. So we could go lower before we go higher. That's not impossible at all. But we'll see. We've got earnings tomorrow, which is going to be a big deal. The name of the game is zooming out and looking at the big picture. After you had that initial weakness and uncertainty from the tariff king, the thing absolutely took off and ripped higher. So if we went to 85, so here's interesting. It peaked at 107 in 2016 and dropped to 84 before the inauguration. Here we're peaking at 117, which would imply, so it's 10 points higher. So maybe we get 10 points higher than the low. We would bottom around 90 or so versus 85 like the last time. So we're probably close to it. Maybe we go down to 85 like we did the last time before going to 185. But all that is effectively noise. The key is to zoom out, see the big picture, and it's going to recover, and that's where it's at. Then what else? 50, which is the IBD 50, which is Momo stocks, growth stocks, were weak into the election, and then they took off. So let's see what's going on this year. A little bit weak into the election, took off, so maybe we'll see some similar stuff like that. IWM is also small caps, shot like a rocket, consolidated into the inauguration, and then kind of grinded sideways for a half a year before a year-end rally. We covered that. KWeb, same as BABA, continued to weaken, and then after the inauguration, took off, went from 30 to effectively 54 in less than a year. Equal weight, weak into the election, same story. Semiconductors fell into the election, grinded for a few weeks, and then continued the uptrend. Let's see what semiconductors are doing here. Yeah, same thing, kind of grinding. Very interesting setups here. S&P was weak into the election, shot up, consolidated those gains, and then just kind of grinded higher the whole next year. So let's see what SPY is doing. A little bit weak into the election, shot up, and it should continue to persist, which would be kind of interesting. Solar, very weak into the election. It's almost as if they knew the election outcome. Same right now, very, very weak into the election. And then what happened? Bumped around for 2 months and then recovered. So there might be some opportunity in solar. We've been talking about in the last week or so that we'd be keeping our eyes open, and we will. Biotech, very weak into the election in 2016, ripped higher, week into the inauguration. Looks a lot like Baba, and then from 58 to 88 in less than a year. So let's see what this is doing. Little weakness into the election, shot higher, grinded sideways, so that we could see some weakness before strength resumes. Here is oil servicers, XES. Had a little weakness into the election, straight up like a rocket ship after Trump got elected in 2016. Into the inauguration, as soon as he was inaugurated, complete crash, 50% crash in oil servicers from the inauguration till August of that year. Let's see what's going on right now. This might be a great short for next year. Oil servicers, so it shot up after the election. Let's see if it keeps grinding higher into the inauguration, and we may put that on as a short in January. That could be an incredible short. Let's put that down. Again, these things are not going to repeat, but they are going to rhyme. Here's in materials was weak and then just never looked back. Let's take a look at materials. Little weak. That could be an interesting long. We have an Albemarle for that already, which is doing well. Communication services, a little weak and grind, and then straight up. Little bit. Okay, we'll see. Energy, same story. Shot up after the election. After the inauguration was a complete short into August. Let's see what is happening here. Little weakness into the election, shot up. So this would be another short after the inauguration. As he announces, I'm sure, drilling on every federal land under the sun. They will move all the moose and the elk and the deer into retirement homes and drill, baby, drill. XLF, again, was kind of like sideways into the election, shot straight up, and then grinded sideways for a half a year. And let's see here, shot up. Probably grind sideways for a half a year. Regionals, I think, have a little further to go. Let me just see here. KRE. Yeah, same story. Shot up and then grinded sideways for a year. All right. Industrials shot up after the election. Kind of kept going. See what's going on here. Shot up after the election. We'll see if it keeps going. We had a lot of strength. Okay, tech kind of bumped around for a couple of months and then just continued to persist higher. Let's see what's happening here. Shot up a little bit after the election. We'll see if it continues to persist higher. I think there's some opportunity here. Staples was not only weak into the election, went even lower. So if we get a lot of tax loss selling in December and we find a bottom there, there's probably some opportunity in Staples. Let's just take a look here. So yeah, look at this. Staples was going weak into the election, got weaker, and then bottomed in December before recovering completely. So probably some further weakness, and then there might be some opportunity there. Utilities were absolutely weak into the election, grinding around, and then started to work higher. Let's see what utilities have been doing. Weak into the election, same type of story. So there'll probably be an opportunity in a few weeks to take a look at some of those. Healthcare, super weak into the election, spike, weakness again into December, and then totally took off. I think there are going to be great opportunities in healthcare. Weakness into the election, we'll probably see a little more weakness, and then there'll be opportunities. So these are places to look. XLU, XLK, XLV. Consumer discretionary, week into the election, never looked back. And that's what's one that we've been talking about since the summer. Time to get loaded up on discretionary, and that's what happened. Let's talk about what else here. XOP, I think we covered. These are basically, these are exploration and production stocks. Down into the election, straight up after, and then down into the election, straight up after. This probably rips higher, and then that becomes a short after the inauguration or shortly before it. Retail. This will probably get hit by the tariffs. This is going to be a short. Week into the election, huge rip into December, and then straight down from there after the inauguration. Let's take a look here. Yeah, shot up after the election. That could be an interesting short. And that's it. So there you go. There's your Trump trade 2026, 2024. Now, wanted to zoom out on a number of names we've discussed on the podcast, some of which we own for clients and personally across accounts. So this is Advanced Auto Parts. We're going to cover a little bit about the earnings. Basically, they shut all their unprofitable stuff in the West that they had no economies of scale. And now they're going to have an absolute cash machine with a clean balance sheet. And that's why the market was rallying today off of earnings. So that's good to see. But in the scheme of things, this is what their normal bottoming process looks like. These fake outs, and then it slowly grinds higher, and no one believes it, disbelief, and then it recovers. And then same will happen with Advanced Auto Parts. Albemarle continuing to climb higher from those lows when we were talking about it on the podcast. ASOS has been dead money for a year. It's a tiny position, and we'll keep an eye on it, but no reason to add on that yet. And no real reason to get out either. Boeing is trying to really flush out the last few weak hands in the stock. This makes absolutely zero sense. Anywhere I have money, I'm buying more. Personally, across client accounts, this is one of these that could go to 100 before it goes back to 400. But I wouldn't bet on that. I think this is actually, you know what? Let's take a look and see what it did under Trump 2016. I think we're going to be referring back to these charts a lot. Let's see today, now that we have a sweep. So it was sideways, kind of grinding into the election, and then it didn't even look back from 100 to 300 in a year after Trump got elected. What's interesting about that is it basically had come off of this super low in early 2016, and then it didn't go back and test it, but it was just grinding sideways, doing nothing. And then somehow after the election, it took off. We had that low in late 22, grinding sideways, didn't retest the lows. We'll see. But, what if you look at when Trump was elected right here and then inaugurated, the thing just went straight up for the first 2 years Trump was in office. So there's something to be said for that. Baba, okay, they've got earnings tomorrow, shot up, fake out. We covered, what it did. Oh, here, by the way, this is kind of interesting. This is when Trump was inaugurated, right here. So it was in a shoot up off of lows, pullback. This is really rhyming like nobody's business. So it probably goes, in that theme, it could go lower all the way into January, barely lower into the mid 80s. And then it went straight up to 207 the first 2 years that the tariff king was in power. So I don't like it. I don't like 6 more weeks of pain. I do like 6 months of massive gains. So delayed gratification there. We'll see. Let's see what happens with earnings tomorrow. Baxter, same nonsense as the 2014 to 2016 lows that we've had from the 2023 to 2025 lows. It just keeps doing these grinds and fake outs until it finally breaks out and then recovers big time. We'll cover some of those earnings. Baidu, we've only touched on barely. CCI, this is interesting. Crown Castle, down because of the rates, but this will recover. It'd be interesting to see what happened just for, some giggles. Very fascinating. Was super duper weak into the election and then never looked back, 57 to 87 over the next 12 months. Let's see what happened here. Super weak into the election, same thing. So Crown Castle, opportunity to pick up some more. Cooper Standard shot up to 17 this week, pulled back today on that EV subsidy removal, which makes 0 sense because all of our models are based on ICE. Hybrids are whipped cream. And EVs is not even in our model, but the market has to react with the algos, no big deal. Actually, let's see what happened. Now I'm really curious about all. We're going to be here all night, ladies and gentlemen, but that's fine by me. You can tune out whenever you don't like it. But let's see. It was weak into the election. I don't have oh yeah, I can make a daily chart here. Hold on. CPS was weak into the election, shot up, pulled back. Weak into the election, shot up, little pullback, straight up, and kept going. Interesting. Okay, good. Little Cooper Standard action. Comstock Resources keeps pushing higher. Diageo, interestingly enough, emerging market stock. Look at this. Super weak into the election and then took off and never looked back, these emerging market stocks. Unbelievable. Same type of setup. This downward grind, low at the election, and then took off the bottom. I like that Diageo. Disney shot the lights out today. As we had said, the parks and experiences were worth 85 alone. We thought the streaming TV and movie was worth at least 100 over the next few years. Today they proved it out. 4 million new subscribers. We'll talk into some of those details. Stock shot up to 109. And if you remember me pitching it in the 70s and 80s and 90s, you couldn't give it away. Still people are skeptical. So, that'll be what it'll be. But this thing is just getting going. So pretty excited about that. That's just a regional bank ETF. Estee Lauder, here's another view. You just zoom out, weakness and then recovery. Etsy, pretty interesting, was in a downtrend into the election, continued weakness after the election, and then never looked back from $10 to $70. We'll talk a little bit about that one. Here is Generac, had great earnings. This thing is really just starting to rip. You might get a little bit more bottoming for the next couple of years, but with a two handle, this starts to get really interesting with more than a double plus. We'll be taking a look at that. Goose is just doing what it's doing. Interestingly enough, Goose was crappy in early 2017 and then went parabolic into 2018. So Goose is going to be just fine. That's a China recovery play. Going to trade like Baba. GXO, huge rip on the buyout rumors. It's been grinding sideways. We'll see what happens with that. Hormel. Intel all the way up to 26. Now it's at $25, down up from 18. So this recovery is just getting started. Interestingly enough, saw something similar in 2016 into 2018. JD, same fake out pullback that we saw in 2016 after the inauguration, and then straight up from there. Regional banks. This is getting a little bit extended. I think maybe after the inauguration, if it's in the mid 70s, I might trim some profits here, because if you remember, we bought this way back in the Silicon Valley National Bank crisis in 2023. So this has been more than a double, and we want to start to not be pigs at the trough. PayPal. Interesting. PayPal was putting in a base in 2016 and 2017, a couple months after the inauguration, parabolic move. Let's see, ladies and gentlemen. I mean, this thing, again, no one would buy it in the 50s and 60s when we were pounding the table. You know, some of the hosts would look at me like I had 3 heads. Now it's in the 80s. So definitely going to 100 in the near term. And then I think probably a lot more over the next couple of years. Alex Chris is doing an incredible job. QXO, just waiting for a deal announcement at any point. Probably take longer than everyone expects. That's usually the way it works. Stanley Black & Decker, same type of basing, choppy volatility like you saw in 2016 before finally breaking to the upside and making new highs. Small caps here. Little chop into the election. Straight up into the inauguration, and then grinds higher for another couple of years. So we like small caps continued. And then interestingly enough, VF Corp was building a base back then as well and did exceptionally well as an emerging markets play after the Trump inauguration into 2018, more than a double in just over a year. So we like that. And biotech. Look at this, ladies and gentlemen. It had put in its bottom and then little weakness into the election. And then after the inauguration, straight up, broke out to new highs. So biotech is going to continue to run. This is all about patience, ladies and gentlemen. Now, I want to go. So look, I'm telling you right now, next week's podcast is going to be like 12 minutes because we are covering 4 weeks worth of stuff in 1 week. Why? Because we just had a massive sea change in our political landscape. And I want to get you guys thinking correctly because most people out there are going to be dramatically faked out with recency bias, thinking that the first moves are going to persist. And as you can see, the first moves in some cases are monstrous fake outs. Here is the US dollar. And as you can see, it topped back in October 2022, collapsed, has been in this sideways range. I think we're at the top of the range and we're going to start to continue to re-weaken. I want to go through a bunch of commodities because we haven't done it in a while and I want to get everyone on board. So Bitcoin, animal spirits through the roof. Ethereum, rip. The thing about Ethereum is it actually has some practical use applications. I have a good friend who is one of the major people involved in that in size. And when he explains it to you, you're like, okay, that makes sense. But the other stuff, not so sure. Here we go with commercials getting long, hedge funds getting short the euro. So maybe a little bit more weakness before we see strength. As a matter of fact, we saw weakness right into the inauguration in 2017. And then what happened? The euro ripped higher for the next year. Australian dollar, same story, similar story rather. British pound. Already had kind of a move. Canadian dollar. Look at commercials buying hand over fist like nobody's business. Hang in there, Canadians. You're going to get some strength. Japanese yen. Commercials have been buying ahead. Saw a little strength. I think that's going to resume. Let's look here. We got Swiss franc. No one really cares. All right. What else? Mexican peso, New Zealand dollar, similar to the Australian dollar, Brazilian real, flatline, South African rand, flatline, Bitcoin we covered. All right, let's get to the good stuff. Crude oil, commercials have been buying while hedge funds have been shorting. I think we're going to see some strength in oil in the short term. What else we got here? Gasoline commercials have been buyers while hedge funds have been shorting. I mean, you always want to bet with the commercials. Same with natural gas. They've been aggressively buying. Okay, bonds, baby, bonds. Let's look at this. 10-year. Where's the 10-year? Here we go. Commercial. Okay, hedge funds are the most short that they've been since 2018, even shorter than when we called the low in October 2023, and you got to rip your face off rally. So the last time they were this short was 2018. And what happened? You got the biggest rally in bonds of all time, compression of yields. I think you are going to see a rally in bonds and a compression of yields in coming months. So this is a short-term counter move. Hedge funds are shorting in the hole, and there's a guaranteed rip your face off coming to everyone shorting bonds right now. And by the way, we've been buying some TLT. Okay, let's see what else we got here. Corn looking closer to a bottom than a top. Same with soybeans. They can take a while to build a base, so I don't want to draw any, we're not trading any of these. I just want to give you a sense of how things are looking in terms of inflation. A lot of these things are just coming in quite a bit. Spring wheat, oats, rough rice, canola. That's the S&P, that's the NASDAQ. Russell small caps is just breaking out to all-time highs, just like we saw after the election in 2017, and then climbed higher after this breakout. So that was the election, November 16, then some follow-through, then it broke out and continued going into 2018, so very interesting. Let's see if there's anything else here we got to cover. I go through all these things every week. Live cattle looks like more like a short than a long. Feeder cattle, same thing. That's good. Steak prices come down. I like to eat steak. All right. By the way, if you ever get up to Ridgefield, Connecticut, there's this place called Hoodoo Brown. Get the beef rib. It's the greatest piece of meat you will ever eat in your life. Absolutely incredible. And yeah, interesting. All right. Jeez. Gold. Hedge funds are tripping over themselves to buy more. Commercials are shorting at the top. I'd take the side of commercials, but it could persist for many months before it collapses. Copper. Dr. Copper shows signs of the economy. It's showing some strength here. It's usually a precursor for China growth. They're stocking up. The demand is growing. Palladium weak. Remember when you couldn't get it? Everyone wanted palladium a couple years ago. I remember all the Ask Me Anything questions. What about palladium? Right here. Everyone wanted palladium. I think it was on the EV bullshit. Excuse my language. Uranium. So now everyone wants uranium. That'll be the same story. 2 years, I'll say, remember when everyone wanted uranium? Cotton. I think that is a long-term story. Cotton. So that speaks to inflation. Coffee. Wow, coffee. All the hedge funds are long as hell, and commercials are shorting it. That's a short. Coffee is a short. Might take a couple of years, but coffee will be much lower 2 years from now than it is today. And it might go a lot higher before it goes lower. That's why we're not in the commodities business, we're in the equities business. But cocoa, same story. OJ, that's going to be one of the biggest shorts. It's been putting in this top for a year. Probably collapses after February, after their winter season. And sugar. Okay, some market indicators. Maybe it should be a $75,000 call, not a $50,000 call. All right, let's see here. Put call ratio, 10-day moving average. Most of these, the theme you're going to find as we scroll through these is they're all in the middle. They're in no man's land. They're not at extremes. A couple of them are where you would want to do a dramatic change in your allocation because everything looked overbought or oversold. Dow intermediate term breadth momentum. This is usually what you find closer to bottom. So maybe we're closer to a bottom on that. I don't know. McClellan summation again. You know, it does look like after this, we covered last week the seasonal weakness in late November in an election year, after the initial surge in early November, you get weakness into the end of the third week before that recovery into December. So that's what we're dealing with right now. That's why everything is kind of mid-range here. PMO by SPX. At 100, I would start to say, okay, but, you know, there's not a signal to wholesale buy or sell anything right now. It's very selective and very nuanced. Okay, let's go into the charts of the week. Margin debt below averages. So again, this is not extreme like you saw in 2021. Scrolling down, this is just a change in the Fed. We'll cover some of that in a minute. Here is a chart of the Japanese yen, looking like a bottom here from Kimball Charting. I thought that was interesting. This chart I put up here, this is the Fed funds rate. And the reason is I wanted to show you what a mid-cycle easing looks like. So most people think this has to go all the way back down to zero, and then you get one of these gray lines, which is called a recession. And it's simply not the case. What you can have, like you had in the 60s, was a mid-cycle cut. Here was 200 basis points. The rally lasted for another 3 or 4 years. Same thing here. And the best analog, in my view, is this 1995, where you had cuts from 625 down to 450, and that's it. And the game kept going for another 5 years. So I could certainly see a move down to, like I've said, I was in the minority camp that our terminal rate would be 4 versus 3. And listening to some of the Fed speakers, I think that's becoming more and more realistic. And that would look a lot like the mid-cycle's cut. And we've got enough growth, demand, and demographics to drive the economy and the stock market with 4% rates. So here's the Japanese yen here. Like I said, I think this is going to resume strength. Here is the channel for the dollar. I think this is going to resume weakness. And same thing here. PMI diffusion, encouraging signs for manufacturing, we've covered. Central banks on your side. 74% of major central banks are in easing mode versus only 9% in July 2023. So this is what you see at the beginning of cycles, which with business-friendly growth policies coming to a theater near you, this can extend for a very long time. History suggests the market rise in the 3 months from the date of the election before leveling off, which would imply January, which would imply all the charts that we've already gone through. The Bank of America bull bear indicator is bullish, but not at an extreme level. So we're in this kind of mid. A lot of people have gained huge home equity in the last 3-4 years, which has a wealth effect. Biggest inflow into small caps since July of 2024. So people are getting the message. Tech outflows, biggest outflow in tech since 2002. China home sales rises the first time this year, so the stimulus is taking effect. The market doesn't realize it yet. Maybe it takes them till January to realize it. Maybe it takes them till tomorrow. I don't know. Goldman's sentiment indicator, all I can tell you is the reload on the options that we took off in early October. which was absolutely incredible, is in full effect. So we get a few more weekdays or weeks. We'll top up a hair, but we've been, today was a busy day, and we're happy to be fully reloaded. Goldman sentiment, and by the way, we've not touched the stock. The stock is the stock. Not sold a share. We have bought shares as we've gotten new cash in, but that's that. Goldman sentiment indicators moving up. Election years, seasonal composite, November 11th through March 15th. So this is what we were talking about. You get that rally in the early November, weakness into the 18th, and then you start to get that recovery all the way into year end, into the inauguration, and then you get the grind sideways for like 6 months. So we're probably getting close to, what is this? So probably by Thanksgiving week, we start to recover a bit, and then rally into year end. Over the past couple of months, average spending on holiday items has started to rise above 2023 levels. So we're back over. Yeah, this is going to be a good holiday season. I can just sense it, which will be good for Etsy, by the way, which we talked about. And spending is starting to rise. Consumer sentiment has been rising since July. Holiday spending unwrapped. Consumer shows solid momentum as we head into the holidays. Financial position appears sound. 4-year election cycle. So this is the election year. You get rally, then some weakness, and then year-end rally, and then a little bit in the first half in the post-election year. This is since 1900. This consolidation before you get the year-end rally. The midterm year is the weaker year. That would be 2026. UMISH consumer sentiment picking back up, consumer expectations picking up, inflation expectations going down. China unveils $1.4 trillion debt swap program to ease local government pain, holds fire on broader stimulus. So they're just waiting to see what Trump's going to do. But that is huge. That's working in the background, getting no credit yet. But when it comes all at once. Inflation expectations rose in the November FMS. Flip positive. We're going to cover that in the article of the week, what that means. Auto insurance prices still rising. Uncommon reasons to own common stocks. Longevity. Investors will need 6% more in stocks than target date models implies. Scarcity. The supply of U.S. equity shares is falling versus surging demand. Momentum. Buying stocks at highs outperforms anytime returns by 5 percentage points. Profits, broader EPS growth of 13% expected in 2025. Backup plan, $8 trillion of corporate cash can easily become dividend buybacks as needed. U.S. mega caps offer poor value. We highlight the virtues of equal weight indexes like RSP, banks, and mid caps and industrials. That's from Bank of America. And then the earnings, as we've talked about, the dark blue Magnificent 7 decelerating earnings growth. Unmagnificent 493 accelerating earnings growth. That's where the money is going to be made. Equity supply is near 25 lows. Look at this chart. Absolutely mind-boggling. U.S. listed public companies at 40-year lows. Don't worry. When the ducks start quacking next year, the bankers are going to feed them. We're going to see IPOs like it's going out of style. So we've got $7 trillion in money markets, $8 trillion of corporate cash, shareholder and dividend yield at all-time lows. They will change that with buybacks. Equal weight looks historically cheap versus market cap weight. Same in 2001, which we've covered. And what made money over the next 5 years at a parabolic move, small caps, emerging markets, etc. This chart I put out on Monday on Twitter. I think it's gotten over 300 likes now, and probably 50 retweets by now. Trump elected as China hawk and tariff king November 2016. You can see Baba was going down into it, went down another 6 weeks before the inauguration, and then went from $84 to $201 in just over a year. So that's that. Paul Falcone, longtime listener, put this chart out, which we've covered on this podcast many times, but it was nice to see, and it actually confirms this right here, these two red bars. It had been coming in from the base, which we covered earlier, and then there was another monthly week bar, so that would imply December is also weak. If it's going to exactly match, which it never does, I think we could recover quicker, but let's just say we don't. One more month of weakness, and then you get the final parabolic, initial parabolic move that we've all been waiting for, and then once it hits 200, everyone will want it. We'll be laying off some, and then reloading down here for the final move. So we covered the home sales picking up. You don't never see those headlines. Percentage of domestic respondents reporting stronger demand for mortgage loans, even at all-time highs, by the way, in rates or long-time highs in rates. It just shows the demographic demand of the millennials. They just got to get a house. They got to get started. And I heard someone say on TV the other day, marry the house and date the rate. So, get in. You could always refinance lower. Consumer confidence and retail sales volumes going up. Japanese 5-year government bond yield going up. That currency is going to strengthen. It's going to hurt Japanese equities. And prime age population. I mean, it doesn't get any worse than the Japanese demographics. This is an interesting chart. I was posted somewhere on Twitter a while back, and it shows a pattern. Ideal buy for investor. It's what they call stage 1, putting the base, stage 2 when it breaks out, of quite a few of the stocks that we talked about are in this phase here where they're just starting to break out, whether it's Baba, whether it's biotech, whether it's PayPal, whether it's soon Etsy will look like this very soon, and over and over and over. So there are just tons of these, and this is phase 2, which is the beginning of the parabolic moves. Cooper Standard looks a lot like this, actually. And then probabilities of a Fed cut were coin flip yesterday, went up to 80% this morning. Let me see what it was after he spoke. Probably went back to a coin flip again. Yep, just about. Went back down to 60% after he spoke. We're in no rush. Tencent beats estimates with 47% profit jump driven by video gaming. China cuts taxes on home purchases and fiscal policy support. China taps golden bankers for feedback to lift market confidence. So they're not doing this stuff because they're not interested in stock markets. They are. They just, overdid it, and it always takes them 2 years to recover it. This time's been no difference, and now we're at the point with the election and everything else. The question is, does it take us 6 more weeks until we get our parabolic move, or do we get it in 6 more days? And the answer is it really doesn't matter at this point. Yardeni sees S&P at 10,000. That's a big headline, very smart marketing move, other than the fact that if you do the math, it's less than 10% a year return. I think he's being very conservative. Kashkari says economy strong, but inflation not vanquished. Trust me, you don't want inflation vanquished. It's called deflation and very hard to get out of. What you need to know about China's $1.4 trillion debt package, we covered. Roaring 20s on Wall Street could extend into the 2030s after likely Republican sweep, market veteran says. Agreed. We've been saying that for a while. EU bends knee to Trump. We could buy more American LNG. Good for Comstock. China unveils. We covered that. With Donald Trump in power, the dollar is likely to rally but then weaken. This is very important, and I apologize for not covering it early because I have it written down in my notes. The one chart that we forgot to cover, how did it respond with King Tariff, King Dollar, is here was the election. Dollar was a little weak into the election. Rallied like nobody's business from 95 to 103 into the inauguration. And then what happened? The dollar absolutely collapsed the first 9 months of the Trump presidency. So let's take a look at what we have here. Dollar was weak into the election, ripped higher after the election, so it probably keeps going a little strength into the inauguration, and then complete collapse back to new lows below even early March, which would imply we get back well below 99 once again after the inauguration. What about bonds? Well, Trump's going to have no revenue from taxes, and he's going to spend like a drunken sailor. So therefore, short bonds. Everyone's saying, all the smart people are saying, except for the fact that the same thing happened last time. And you got weakness that continued into December, and then you got a rally for the next year in bonds, which is a compression of yields. Weakness into the election, and then we will see a rally and a compression in yields over the next 12 months. Okay. 10-cent beat with a 47% profit jump. So this is foolhardy right here. Dollar will continue short term and then roll over. Citigroup Fraser says it's game on for deals in the U.S. We agree. Disney explores wider field of candidates to succeed Iger. Trump chooses Elon Musk and Vivek Ramaswamy to lead government efficiency effort. So while everyone is concerned about runaway spending and big deficits, these guys think they can cut $2 trillion. Even if they're half right and they cut $1 trillion, that's going to be very, very constructive for the U.S. balance sheet for sure, and deficits. Trump is the most pro-stock market president that America's ever had. That's from Jeremy Siegel over at Wharton. Disney's earnings outlook rises as streaming unit posts gains. So as we said, they've got the new cruises coming out. The movies actually crushed it. Deadpool and Wolverine, they added 4.4 million new core Disney Plus subscribers in a quarter, which was compared to estimates of 900,000. And don't forget, the prices they've been raising like it's going out of style. Blockbuster movies, so the game continues. That game's just getting started. Stocks end lower after Powell throws cold water on hopes for December interest rate cut. Coin flip, but my guess would be he does a cut in December and then he waits for a while. And if he gets to, even if he waits beforehand, I mean, if we have a 450 or 4 terminal rate, he can spread that out over 12 months. So 3 more cuts over 12 months is plenty. And we're there. Alibaba JD claimed big win in Singles Day as sales consumer spending bounces back. Advanced Auto Parts to exit Western U.S. as it closes more than 700 locations. Will focus on the strongest markets in the eastern part of the country. And this has to do with the supply chain. This chart is blew my mind, okay? If you look at how spread out this is, and basically they're getting out of California, they're getting out of all the West Coast where you're incentivized to steal products and not go to jail. So they're just going to cut bait there. And then you're going to see where they're going to keep all this incredible concentration on the East Coast and just create a money minting cash flow machine with a healthy balance sheet. And that's why you saw the stock up today. And that's why you're seeing the beginning of the recovery. Never bet against Shane O'Kelly. And we're just getting started there. So very excited to see that turnaround. Everything he said he was going to do out of the gate, he's been doing step by step periodically and doing a good job at that in a weaker, lower end consumer environment that is showing signs of recovery. And I think we're going to see it in the holiday season. Inflation stays firm, but not enough to derail December cut. That was from the Fed Whisperer before Powell spoke today. So we'll see if that gets updated. Billionaire Tillman Fertitta is unhappy with Wynn Resorts' performance. We've been looking at Wynn a lot. We didn't get involved because it's another play on China. We've got enough exposure to China, but I think that's going to be a big win. For those of you who don't have China exposure, Donald Trump secures control of Congress as Republicans win House majority. JD reported in the earnings call, he said, as overall consumer sentiment continued to brighten, revenue was up 5%, net income up 23%, EPS up 29%. Company repurchased 8% of their shares, announced to purchase $5 billion more worth of their shares. So the game continues. Sentiment will follow. This is Baxter's earnings. A couple of you asked. The key here is that the restructuring is going according to plan. Balance sheet deleverage from the sale of the biopharma business will go as planned. And the name of the game with these turnarounds is that the balance sheet gets deleveraged and revenues keep growing. And that's exactly what happened in the third quarter. And year to date, despite all the headwinds, they grew revenues 4%. And year to date in the quarter, they grew at 3%. And increased earnings per share. And they've got their plan in place to reaccelerate margins. So you can see segment by segment how they grew. Infusion therapies plus 7%, advanced surgery plus 7%, care and connectivity up 7%. So the injectables and the anesthesia was down. That was the big loss, 9%. Drug compounding up 17%. So everything was basically up. The whole revenues were up. So the turnaround is in place. The balance sheet is getting healthy. This one just takes a little bit of patience, but you know, some go faster, some go slower. Here's one that's gone faster. This thing is unbelievable. You couldn't give it away at $90. Generac, now it's at $196, going to $200. With residential product sales, we're up 28%. Unbelievable. Commercial is still in its recovery stages, and maybe we'll do this one or two of these next week. And then Etsy, we talked about a few weeks ago. We got a $49 basis. We went into some detailed analysis of this. The name of the game is they picked up like 50 million people during COVID. Massive growth story. It got up to $300. The key thing here is, unlike most of these retailers that shot up during COVID on no profits and no just revenue growth because everyone was at home with checks to spend, most of them collapsed and went out of business. A bunch of them in the UK, like Farfetch and everything else. I think ASOS will be left standing as the competitors go out of business. But Etsy was able to hang on to all of those clients and all that cash flow and even continue to grow revenues. How do you grow revenues after you have a period like that? And they've been able to do it. And now they're going to reaccelerate. So we're about an hour and 5 minutes in. You could go to hedgefundtips.com. I want you to read all of this because it's a very exciting story. And the reason the stock is down almost 90% where we're buying it, 85%, that tends to be our sweet spot. We like to buy quality businesses down 85% when their cash flow is steady and revenues are still growing. It's mind-boggling. Wall Street is the only place when they hold a clearance sale, no one shows up, and that's our knitting. Turnaround Tom for a reason. Etsy also tends to do well during the gift season, and I think they're going to do it much better than anticipated. But the key thing here is not only have they been able to keep the cash flow, but they've been able to bring down the share count from 127 million shares down to 110. That's going to go down to 100. Revenues have continued to grow. I mean, who can pull this off in that environment? And their return on capital, they continue to have very high double digit. It's a capital light business, double digit return on capital in 20s plus. Good seasonality and a plan and a differentiator. While all these other retailers are race to bottom, selling crap at rock bottom prices, Etsy is unique in that it has creators, 96 million users across of its platform, which makes it the number 3 in the total e-commerce business. And huge international growth opportunity, huge mail growth opportunity, and gifting opportunity. So it's exciting. And 9 million active sellers. Return on invested capitals are huge in this business. And this is the type of business that you want. So I think they will continue to grow the international. They'll continue to grow the men's. They'll continue to reaccelerate. Now they've got the app. They've got the frequency of the buyers going. Everything is in place to deliver. And this CEO is a winner. If you look at his bio, you'll see all the things that he's accomplished before this, and you'll be impressed. So just want to see if there are a couple key things here. So just go through that. Everywhere I put stars and underlines, you want to follow that. Bank of America's sentiment survey was out. We put it out on Tuesday. While you're at Hedge Fund Tips, click on terms. This is opinion, not advice. So 5 key points. Number 1, it's a positive, not a negative, that managers think CPI will be higher next year than this year. It is the same at each cycle trough that precedes a growth recovery, whether it's 2009 or 2001, etc. That's what you see every single time. Sentiment is improving, but not yet euphoric. That's what you see again out of these big troughs. That's not a top. That's headed towards a rally. And then managers are dramatically underweight materials and energy. I definitely like some of the materials story. The energy, a couple more months, and I think if they're at excessive valuations, I'd be lightening up. Long gold is getting very crowded. It's the second most crowded trade, and managers are the most overweight gold that they were in 2011 when the last top was in place, and that lasted for 9 more years to make a new high. Managers starting to get out of equities in Japan, which we've been talking about for months. Sentiment, again, it's elevated, but it's not yet euphoric. I think it's down to 63 today on the fear and greed. And even the National Association of Active Investment Managers is stuck in the 90s, which is high, but not extreme. Earnings, oil and gas equipment services, down 20% in the last 60 days. So again, I'd be fading this rally in the next couple of months. ARC Innovation, on the other hand, is up. Top 30 weights in the last 60 days. Earnings estimates for 2025 up 6%. This one's probably going to work. She's probably going to start to be back on the cover of magazines. So, kudos for her hanging in there. Moving along, economic data, CPI and PPI came in line. Let's see what's going on with employment. Continuing claims moved up again. So that could be enough cover for the Fed to follow through in December. We shall see. And going to see some retail sales tomorrow. All right. And now we are on to the Ask Me Anything questions. So for those of you who like the Ask Me Anything, stick around. For those of you who don't, thank you for joining us. We'll be back next week, and hopefully much shorter next week, but we'll see. Will says, can you help me understand when you say the U.S. debt is going to be inflated away with inflation being 3+%? I don't think there's anything to add there, Will. It's exactly what I said. It's the same playbook that they did in 1948 to 1956. You can look at debt to GDP, dropped from 120 to 53%. Look at inflation across that period. It was consistently 3 to 4 to 5% per year. And that was a good playback to bring the rates down. The debt as a percentage of GDP, because if you grow nominal GDP, debt stays fixed, and that's how that ratio, or nominal GDP, grows much faster than the fixed debt on a ratio basis, and that's how that ratio comes down. So they run nominal growth super duper hot, and that's, if I've never seen a set of policies and administration that could be in place to run nominal GDP hotter than we've ever said. It would not shock me to see years of GDP growth above 5, 6, 7, 8% over the next 4 years. I mean, that sounds like crazy town. I'm telling you, I think we're going to see at least 1 or 2 years like that, which is going to be amazing. So, hey, Tom, thanks for all the information you provide every week. Any thoughts on BACS? BACS we just covered. Aaron L. Huntington Ingalls. think that's HII. Okay, let's take a look. Cash flow is dropping a lot. Gross margins dropping, return on capital is dropping. Not for me. Everything's going in the wrong direction for now. I need to see some signs of recovery before I got interested in that. Lars Lund, care to look at Genmab from Denmark? Let's take a look. Gross margins are moving down quite a bit. I want to understand why that is. That's a red flag. What do they do? Therapeutics. Yeah, this I have no edge on individual drugs and all that stuff. I just buy a basket of XBI, so I have no value add there. Interview request. Michael Gower. Celanese. Yeah, specialty chemicals. I definitely want to get involved in more of these in the material space. Let's see what this one looks like. Yeah, these are so cyclical that it's hard to analyze it as a good business. It's more like a 2-year trade. This one's really interesting. I mean, I have to take a closer look, but you're definitely catching a falling knife. So, it could go to 50 before it goes back to 170, but as long as you're not on margin, it's not a big deal. This is a quality business though over time. What do they do here? Engineered polymers. Automotive and medical applications, industrial products, consumer electronics. Yeah, I like this. Let's see what the balance sheet looks like. But are they generative polymers? That's the question. Are they large language polymers? I don't know. Let's see. All right, so revenues are down a little bit. Share count is coming down, so they're buying in stock. Cash flow. I'm going to make this a little smaller. Oh, that's not what I wanted. That's what I wanted. Yeah, it's holding in there. What's the balance sheet look like? This is probably the risk. Ooh, $11 billion of debt with $800 million of cash. Ugh. Got enough free cash flow. You just got to check when does all of the debt mature. And if you can get comfortable with solvency, I think that This is probably okay and is just in a cyclical trough. And I think it's a reasonable find to start to do work on. Good job, Mike. J Apt, Ulta Beauty. We cover this one every week. I think it's fine. I know Buffett sold some of his position, but I think it's okay, but I think there are better uses of money, which why I never got excited about it. John C., Dollar Tree. These are the type of businesses, though. The retailers are going to get hit on the tariffs, but Dollar Tree is already so far down, and same with Dollar General. I think I want to get involved with one of these. It's just going to take a little while. I mean, it's had a heart attack, but I think it's going to be okay. I just think that your upside is limited. So you basically have a double over 3 years, and it could go 30% against you before you get the double from these levels, is what it comes down to. They'll close unprofitable stores. It'll be the same thing. They all overexpanded. It's kind of like the Advance Auto story with less upside. That's the way I would put it. So for me, it would be basically the same trade, and I don't overlap. Then you're just running, an index fund. So you got to pick your bets. I think Dollar Tree is probably a little higher quality than Dollar General. Still generating cash. I think you're probably okay with this one, but you got to do the work on it now, John. So, but definitely hard yellow light to start the work. Are you adding to Alibaba before earnings? I would never add or subtract before earnings. I don't own for an earnings call. I own because I have enough margin of safety at the price I'm paying for the business, and I sell it when I'm getting quoted in the market for far more than I believe the intrinsic value of the business is worth. And we are nowhere near that point. So we reloaded all the options that we took profits on in early October when it was at $117. And we'll probably potentially have a chance to top up a few more in coming weeks. But I think the window is going to close pretty quickly. So am I comfortable with the position I have? I couldn't be more comfortable. I just, every new money that came in gets an allocation of BABA. Even at these levels, it's cheap. It's one of the price is what you pay, value is what you're going to get. There is no better value in the global market, for my opinion, where you have your downside totally protected with the net cash that they have on the balance sheet, growth prospects, everything else, optionality, outs, all the good stuff is in place. Are you adding? Okay, same question. Tim D. Thoughts on solar? We covered earlier. Looking, haven't found, but looking hard. Have you looked at Airbnb? Yeah, and I think we covered that a few weeks ago. I think it's okay. I just think there are better uses of money. But I think it's okay. Let me just see. Seven times sales, 47 times earnings. So if you're going to pay 10 times, 47 times earnings and 10 times sales, the key is going to be what's the growth rate. So 10% next year and 16% in the year after to pay 47 times. That, you know, for me, it's not enough margin of safety, so I'm a pass. That's a trade. That's a trading vehicle. Thoughts on HBI? Yeah, it's just a low quality business. I said it would work as a trade. It probably already is. Let's see. Yeah, so this will push a little higher. It's not something that I want to get totally excited about because this thing just keeps running back down to nothing. Not a good business. Surya Rajesh. Elliott announced a stake in Honeywell. Is it interesting for me? Yeah, anything Elliott does is interesting for me. Honeywell, I'd rather have Boeing. I think there's way more upside for Boeing. This has already had a huge run. I like Boeing. So he's going to break up, do some of the parts. Basically, he's going to just get a payoff to go away. And that doesn't help me. It helps him. What are your thoughts on Berkshire being in lots of cash? The last time he was in this much cash, the market rallied thereafter relative to equity. So there's no real tell in that. I think the guy wants to go out like Seinfeld. And the last thing he wants is, I think he was preparing for a different outcome in the election. And he thought he was going to be able to deploy a lot of that cash. But what you don't want is to be 94. Your stock goes down 50% after a lifetime of pristine reputation, and you go out down 50%. So I think this guy is more preserving legacy than looking for upside at this point. And you know, he's probably not finding everything he wants. I think he should probably take $100 billion and buy Boeing, but that's just me. He should have done the same thing with GE. Kyle Burns, can you please take a look at Herbalife? I know Ackman very publicly shorted, seems undervalued at the current price. I think it's a great business. The problem is that and I have looked at this one a lot. Until you see side effects being reported from the GLP-1s, it's problematic. I think they'll continue. They have the China recovery play here. For sure, their India market is flying. They've got a great product, but it is, you know, as much as it's a nutrition company, it's always been marketed as a weight loss supplement company. And in the developed market, there's just no real momentum. I think the people that, I think as the prices come down for these GLP-1s, if they continue to prove efficacious for the long term and safe for the long term, yes, people will need protein shakes, and Herbalife could be a beneficiary of this. But it's a much different story to sell if it's not being used for the weight loss, and if it's just being used for nutrition and protein. So this would be the buy of all buys if and when you start to see headlines about either insurance not covering it or side effects. If you start to see side effects, this thing's going to quadruple. But there's no sign of it. And, you know, diabetic people have been taking GLP-1s for decades. So until you see people using it for weight loss start to report stuff about kidneys or livers, which may never happen because of the drug's been around for so long, used for different uses, I think the growth story is going to be very, very hard, other than a recovery in China for nutrition, and I think they have some skincare products, etc. Could be very, very strong. But, you know, you're seeing the same with the Medifasts and the USANAs and the Nu Skin. They're all super cheap. Nu Skin is more skincare and vitamins, so they'll actually recover better when China recovers because they're not weight loss centric. I guess the simple answer is it's a great business, but with the GLP-1 overhang, until something changes, I don't think it's the best, highest and best use of capital, and I'll leave it at that. Moving along, but I definitely objectively see what you're looking at there, and I think that's where it is. James, thoughts on Goose? No change. We own it. And that's a China recovery play like Baba. And that'll be fine. Thank you for everything you do. Zcar, given the new CEO. ZCAR. No, not interested. Next. Matt Tumbo. A-Rock. Been watching for a year. Thanks. Glad you're enjoying it, Matt. A-R-O-C. Arch Rock. I think you missed it. It's more interesting at 150 than it is at 24. Let's just see what's going on here. All right, so the cash flow recovered. Their stock priced it in. What do they do? Energy infrastructure. Yeah, I think this is one to short after the inauguration. Energy services. Martin C. Greetings from Poland. NCSM. Guarantee we're going to see an unbelievable increase of share count. Not huge, from 1.7 million up to 2.5 million. Revenues. I mean, this is a tiny company. I don't know. It might work. What's the balance sheet look like? $15 million of cash. Yeah, I just want to understand, the key is, have they changed who's running it? Because this was a complete disaster. So if they got new management in that has a track record of success, then this thing's probably going to recover to 50 and beyond. If it's the same schmuck who ran it from $555 down to $6, then I would say take a hard pass because they don't respect equity. But yeah, I mean, I think you got something there. You just have to do a lot of work on it because these smallish companies tend to have mediocre management. Scholler Bleckman, oil field equipment. Under Trump administration, yeah, until the inauguration, and then their shorts. OELLER. Yeah, if I had to be in one, this probably looks okay also. Yeah, not bad. Yeah, pretty good find. If you want exposure, that one looks okay. Definitely worth doing the work on now. Thanks for that, Wilhelm. I think. Oh, here we go. Software Play, TeamViewer SE. This is from Lars. Yeah, this definitely looks interesting, Lars. I think the number one thing you got to figure out is remote connectivity solutions. So what's their competition and what's their moat? How does this not get knocked off? What makes it special? What's proprietary about it? And why is it not going to change? And if you can get comfortable with all those questions, which are the trick questions for technology, then on a financial basis, it definitely looks okay. Okay, so with that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.